In a broader sense, any revenue for the government that did not come from taxes is called non-tax revenue. However, in the Indian context, proceeds from divestment are classified as capital receipts. This means that non-tax revenue is earned through dividends from state-owned companies and financial institutions, spectrum sales, usage charges and license fees, royalty and fees on petroleum sales and exploration, fees for use of national highways, postal revenues, etc. The three main components of non-tax revenues are dividends from state-owned companies, dividends from state-owned banks, financial institutions, and the Reserve Bank of India, and telecommunication revenues, including sale of spectrum. Dividends from PSU since 2019 have fallen short of targets as the bottom lines of state-owned companies have been affected by an economic slowdown that started even before the COVID-19 pandemic hit in 2020. Communication revenues are also dependent on larger economic realities. In 2020-21, the centre's plan to auction 5G spectrum was delayed due to the COVID-19 pandemic. The biggest contributor has been dividend from PSBs, state-owned non-bank financial institutions, and the Reserve Bank of India. A major chunk of this portion comes from the RBI, which is somewhat unscathed by economic realities. For the 2020-21-22 financial year, which is the 2020-21 accounting year for the RBI, the central bank transferred Rs 99,122 crore as surplus. This was for only 9 months as the RBI shifted from a July-June accounting year to an April-March accounting year in step with the government. The amount came as a welcome boost to the government. According to the 2021-22 budget, the estimates for revenue from dividends by the RBI and PSBs stand at Rs 53,510.6 crore. The surplus paid by the RBI alone surpasses that target by around Rs 45,611 crore. This is not the first time that the RBI has transferred a bumper dividend to the government. For its 2018-19 year, which was the centre's 2019-20 year, the RBI had transferred a whopping Rs 7.16 trillion, comprising Rs 1.23 trillion of surplus and Rs 52,637 crore of excess provisions identified under the revised economic capital framework. The excess reserve transfer was in line with the recommendations of the Bimal Jalan-led panel constituted to decide the size of capital reserves that the central bank should hold. The reason why such a sum was transferred and the panel was set up was rather acrimonious one. Throughout 2018, the relations between the Arun Jaitley-led Finance Ministry and Urjit Patel-led RBI were quite strained. The then Economic Affairs Secretary Subhash Garg had internally raised a demand that the RBI should not be holding excess capital reserves and that it should transfer Rs 3.6 trillion to the government. This was the flashpoint which led to a war of words between the two institutions.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.